Good morning, everyone. I'd like to welcome everyone to the BAFT webinar on uneven regulations in the payments industry. NBFIs have brought a lot of innovation, competition, and customer service to the payments field. At the same time, the risk component of payments has increased. In May of this year, BAFT released a white paper on uneven regulations in the payments industry, and we're here today to discuss the uneven regulations across jurisdictions between FIs and NBFIs. I am Deepa Sinha, VP for Payments and Financial Crimes and Women in Transaction Banking. Here with me, I have today Renata Villanova-Lobo, MD in Global Clearing Solutioning and Commercialization Head at JP Morgan, Ken Wong, Head of Global Transaction Banking, Product Strategy and Innovation at TD Bank, and Bruno Mulatto, Global Head of Payments and Receivables at BNP Paribas Fortis. So let's get started. What are FIs versus NBFIs, and what are uneven regulations? Bruno, would you start us off?
Hello, thank you, Deepa. Thanks for the opportunity to be here to share with you our views on the topic. So basically, as responsible for payments for a few years now, and working with BAFT on the paper that has been published, the main message that we wanted to share with everybody and to put this in perspective is that today we have different types of parties in the payment scheme, and we have even more and more participants to the payments ecosystem. However, they have different sometimes licenses in which they can have the right to issue payments and to exchange payments. Nevertheless, the activity is the same. We are responsible for a payment. We're responsible to fill in all the information on a payment. And we believe that regulators and jurisdictions have to realize that sending payments has to apply into the same context of rules, independently of whether you are a bank, a fintech, and another non-bank financial institution, or you are an operator of the scheme. Equally, we believe that today, even if we have a lot of participants coming up with standards, we still have a lot of areas where rules may not be understood the same way. And that's not the fault of anyone, but if it is not sufficiently clear, we may not be applying the same rules all along a payment chain. So this paper tries to understand how we are bringing a bit of risk into the system if we do not all follow the same rules of the game in terms of how to make payments transparent, faster, but at the same time that we're able to apply the required controls, of course, in the most efficient way. And we all have a duty in this ecosystem of payments to fight against terrorism, corruption, anti-money laundering. So you all know that. But we need to have ourselves the means to do it. And that comes by sharing the same rules, the same data, the same understanding on how to make the system work for all of us. And so that risk is what we try to address here, independently of what license, what role you have in the execution of payments. That's basically the main message. Back to you, Deepa.
Right. Well,
I would like to just say a little bit more to that. I mean, from a whether you call it uneven regulation or whatnot between banks and NBFIs, I mean, there is the risk aspect to it too. But then the question always is, from a commercial perspective, does it put one party at an advantage over another party who is providing the same type of service? And the key is, I call it the type of service and not the service itself, right? And that's why right now I would say everyone thinks that fintech and NBFIs are providing a much better level of service than a bank can. The question is why and how, which we'll address about that a little bit later too.
Absolutely.
Thanks. And kind of keeping in line with that same, line of reasoning you guys just started with, what are the potential risks associated with indirect participants not being subject to the same regulations as direct participants? Renata?
Yeah, sure. So good morning, good afternoon, good evening, everyone. So I think that when it comes to direct participants, right, that means that you are a member of a specific clearinghouse, you have direct access to that clearing system. In most of the cases, direct members are banks, but in many locations, non-bank FIs can also be direct members. But though overall, to become a direct member, the participant needs to comply with a variety of rules and control requirements applicable for all members, right? So this is pretty standardized. And for many different reasons, some participants, banks or non-banks, decide to have access to that clearing payment system through a direct member. In that sense, they are indirect participants, right? And usually the one that provides the access to the clearing system is a large bank and a direct participant. And I think there's nothing wrong in being an indirect participant as long as there is a good level of risk management for the type of activity of that participant. So back to Ken's comment, it's really about the risk of the type of activity that it's related to that participant. And I think that the issue is how to ensure that this is the case, right? As a direct member providing access to the clearing systems, how can you be comfortable with the level of controls and risk management framework of an indirect participant? I think that's a key question. And I think there are a couple of risks related to indirect participants, and I would point out a few of them, starting with operational risks. I think when you think about not having appropriate risk management controls and framework, that can lead to operational failures, right? Incremental repairs, processing delays, impact on STP rates. And that can be related to bad formatting, inadequate screening, lack of information. So operational risk would be a main risk related to indirect participants. I could also highlight liquidity risks or liquidity mismatch. So the failure of an indirect participant to settle its obligations can impact the financial stability of direct participants. And that's also considering that indirect participants are not subjected to the same liquidity requirements as direct members are. And in many cases, pre-funding is required, but still, liquidity mismatch is still a risk. Then I can point out to compliance and regulatory risks. So AML and terrorism financing rules are very strict and clearly defined for banks and direct members. And if there is a regulatory breach related to flows from indirect participants, the direct participant, being a bank, is liable for the regulatory breach and its consequences. And that can include fines, increased scrutiny from regulators, or even loss of license. And the fourth risk I would highlight is related to cybersecurity. So usually indirect participants do not have the same level of cybersecurity measures as direct participants, making them more vulnerable to cyber attacks with potential impact on the integrity and confidentiality of the payment system. And I think that overall, when we look at those risks, I think what we're seeing as a result of that is that banks nowadays, direct participants nowadays, have less appetite to support other participants or provide access to the clearing payment system to indirect participants, which is not a good sign for the industry. So I think overall, the potential risks associated with indirect participants not being subjected to the same regulations as direct participants can have significant implications for the efficiency, stability, and trust of the payment system. And again, I'm in favor of indirect participation, but as long as it comes with the proper oversight and risk management measures to mitigate these risks and ensure a secure payment ecosystem, which means direct participants should be subjected to the same standards of regulations as direct members.
Great, thank you.
And maybe Deepa, if I may just add, it's Bruno again. Maybe on the risks as well that should be understood when we talk about regulations not being completely interpreted in the same way as well, you have the sustainability of a specific client activity, because we all have clients across this webinar, and our clients need to work on ways to issue or receive payments that are sustainable in time. And what I mean is that when we have uneven regulations and we have participants of the payment ecosystem maybe taking a shorter route, the consequence that we've seen is that maybe that will end up bringing additional regulation. And so the risk is if we if we have participants playing it differently in the payment scheme, and there are some shortcuts available, at some point, the regulators in some jurisdictions will say, oh, we need more regulation because that was not good enough. So at the end, we all end up losing at the end, as opposed to winning by following the same set of rules and responsibilities. If I give you just a very basic example, take example of Luxembourg in the middle of Europe. So you have payments being now filtered domestically. And if you had followed all the rules to create KYC requirements all across different banking and non-bank participants, you probably would not have had a specific requirement to filter every single domestic flow. So you can see that at the end, everybody loses when there are some shortcuts or some misinterpretations on the rules of the game when it comes to transparency and payment safety. So I just want to add that level, because we forget that sometimes poorly interpreted regulation leads to more regulation, and that's not always the best way. Sorry, go back to you, Deepa.
Thank you, Bruno. Why don't we discuss a little bit about the current landscape? Ken, what do you think is the current landscape, and what does it look like today for banks and fintechs in terms of the regulatory environment?
Great, thank you. I mean, this is something I ponder all the time. I mean, what banks have been doing payments for a long time now, especially cross-border payments. So domestic payments are much simpler. So let's talk about the cross-border part of it. So we've been doing it for a long time. Then the fintech and NBFIs came around, and they seem to have made it much better than what a bank can do. Even though in many jurisdictions, like what Renata said, NBFIs are not direct participants and actually going indirect, right, through another bank. Then the question always comes in, why does that happen? You know, and the question I ask myself is, why, as a bank, when I go to a country where I'm not in, looking for a correspondent to provide me services, I cannot get the same service that an MBFI gets, that, and we banks are restricted to, say, the high value systems, the Y systems, and not allowed to clear cross-border payments through, the low value systems, of another jurisdiction. Then we look a bit deeper into that. We look at the rules itself. Are the rules actually uneven, or is it the application of the rules that are uneven? And that comes to who's interpreting the rules. So I actually, split up the rules and regulations into two parts. One, like what Bruno talked about earlier on, was talk about who the entity is and what they are allowed to do. So it's the whole licensing part of things. And then the other part of the rules and regulations is, how do they do what they are allowed to do? So from a licensing perspective, I think it's quite straightforward. They talk about, as an entity with a certain type of license, what are the services that you can and cannot do? So in many countries, MSBs can do payments but cannot hold deposits, and therefore the capital requirements are different, et cetera, et cetera, et cetera. So to me, the unevenness of that regulation is okay because it talks about the entity and what they're allowed to do. Then it comes to, especially from a cross-border payments perspective, how do you make a cross-border payment? There are rules, domestic leg rules and international rules that everyone supposedly has to abide by. So from a domestic perspective, there are travel rules, network rules. So does the networks physically say you can or cannot put a cross-border, the domestic leg of a cross-border payment through it? There are message standards and data standards within those domestic payment systems to complete the domestic leg of cross-border payment too. So for the data standards within the network itself, does it have enough information in it to actually comply with the travel rules? And then in some countries, there are also reporting rules as far as cross-border payments are concerned. The example I'll give is Canada. It is the beneficiary bank who has to report cross-border payments of certain types. But then if the Benny Bank does not know it's a cross-border payment or not enough information comes in, how can they report? And then there's whole sanctions, any money laundering and anti-terrorist financing part of the equation too. Then from an international law perspective, there are things like FATF 16, which also talks about travel rules, identification of whether a payment is domestic or cross-border, and all the sanctions, data for sanctions filtering and whatnot. So what we've seen in the market is especially for direct participants providing service for indirects, that's where the unevenness comes in. I think the rules are the same, but the interpretation of who you apply those rules to are a little bit different. Also, what we've seen is there are a lot of MBFIs, fintech, whatever you want to call them, MSBs, who in some ways have circumvented some of those rules too. I'll give you an example. I am MSB in 2 countries. I'm trying to move money from one country to another. I'm doing a local collection in one country, doing a capital movement into the second country. But when I make the payment out to the final beneficiary, it is the actual entity that's making the payment. So from a look and feel perspective, even if the network rule says the originating account and the beneficiary account, like in SEPA, has been the same jurisdictions. Yes, it came out from entity A paying a beneficiary. But what isn't taken into account is the spirit of all the rules when you put it together to make the payment system safe and sound. So from a cross-border perspective, and the example I gave is entity A in country B is not the actual originator of the transaction. It's actually the person in the first country who's actually making the payment. All right. So that's how, people have interpreted some of the rules at an individual basis and not as on a holistic basis. And that's where what we find is some of the banks who are providing services, they're looking at it from an individual rule perspective and not the spirit of why the rules are there. Then it begs the question in the long run is for the people who are providing those services, the banks providing services into the payment systems, who's responsible for enforcing it and for interpreting the rules in the correct manner? There are also some jurisdictions where MBFIs and MSBs are allowed to join the payment systems directly. Then the question then is who's enforcing and how are they enforcing it? One example would be, I think it happened in Singapore a while ago where MSBs were allowed to join one of the payment systems, but then MSBs were putting cross-border payments through it, but the banks were not allowed. So that's where the unevenness come in because of the interpretation of the rules and the correct enforcement of the rules. And I think one of the things that we haven't worked out on right now as an industry is who's liable, who's responsible, how do we enforce, and getting the rules a bit more prescriptive to say what can and cannot be done within a payment system. I'll leave it as that for now and open up for discussion.
Thanks, Ken. Specifically, can you guys share some case studies? And I know you can't actually name names, but give us examples of some more examples of where fintech or a bank successfully navigated the regulatory discrepancies between the different jurisdictions, and if they did, what were the key factors in their success? Renata, you want to start us off?
Yeah, sure. So I'll focus on us, locations where we have seen more like harmonization across, the rules applied to banks and BFIs. So starting with Spain and Singapore, I think Spain and Singapore are successful case in terms of defining KYC rules that are very similar for banks and BFIs, right? So the requirements regulate the type of payment services as opposed to the entity type providing the service. So this has been quite successful in Spain and Singapore. I could also highlight Australia as a success case in terms of implementing a risk-based approach to regulation, tailoring requirements based on the size, complexity, and risk profile of the service and providers. Australia has been very successful in defining a regulatory approach that can ensure regulations are fair across all players without limiting competition and innovation, because this is also very key, right? So we don't want to create an environment where regulation is so strict, applied to everyone, but in a sense that it's jeopardizing the ability for new players to compete and innovate. So I think we need to find that balance, and Australia has been quite successful in that sense. I would highlight Canada as another success case, especially around consumer protection and transparency. So Canada has implemented a robust consumer protection regulation, equally applied to banks and non-bank FIs. And this ensures that consumers are protected while allowing for innovation in the financial service. UK is also a great example in terms of a broader collaboration and engagement across multiple stakeholders, and that includes banks, non-banks, regulators, tech providers. So in the UK, all these stakeholders are actively engaged as new rules are being defined. And again, I think that when it comes to harmonizing the rules, it cannot be just on the regulators, right? So I think collaboration, engagement across multiple stakeholders is definitely needed, and this is what we have seen in UK. I think again Singapore, but combined with along with India and Hong Kong, could also be pointed as success cases for collaboration between key players, mainly supporting innovation through a very controlled and well-structured sandbox framework. So Singapore, India, and Hong Kong, they have created, a very well-structured framework for sandbox and innovation labs, which allows, players, including banks and non-banks, to test the water and pilot, new ideas with a very controlled environment. So that has been quite successful. And then India. I think India is a huge success case in terms of the harmonization of rules, especially around AML, KYC, prevention of the terrorism financing, data protection. So in India, they have applied or defined very similar rules to banks and non-banks operating the cross-border payment space. And it's also very interesting in India to see that the rules they have defined locally are highly aligned with the most relevant international standards, right? So the focus is really on promoting competition and innovation in a safe and sound environment. And I think that when you look across all these success cases, I think we can find a very common pattern, which is similar rules applied to providers of similar services, right? So it's the regulatory oversight and regulations based on the risk of the activities and not defined by the license type. I think those would be, the successful cases that I would highlight in terms of finding this harmonization across rules applicable to banks and non-banks operating in the space of payments.
Yeah, just to add on to that, I think the question we have to ask ourselves is it the rules, or what are we trying to achieve in the long run from a payments perspective, right? Regardless of competition and everything else, innovation is, why are we looking at new ways of making payments? Is it, especially from a cross-border perspective, we've been relying on the correspondent banking and wires for a long time, and it doesn't quite work for low-value payments because of all the deductions and everything goes along the way. So we've always, a lot of banks been trying to put it through the ACHs, faster payments and whatnot. So I would say one of the big success stories about that, it's creating a network or a payment scheme that can actually resolve the challenges that we face today. In fact, the US is a good example too, because the US put an IAT in. Instead of putting through the normal NACHA systems where it's supposed to be specific to for domestic payments, they created IAT, and therefore it gave a better service level to the clients, but tailored for international payments. And if you look around the world today, I think that's a huge opportunity. Renata talked about Canada. One of the things that we talk about Canada right now, when we're bringing up our new RTR, real-time rails, and all the other payment systems, is putting flags in and making it so that you can put cross-border payments through it in a, call it, legal and regulated manner. So it's about creating the actual networks and ecosystems that can resolve the problems that we are facing today, and not just regulation on its own, I would say.
Yeah.
I fully agree with you, Ken. And I have to say that it's also, I think it's also very visible nowadays how regulators are looking into regulation for payments in a more, I think, strategic manner. So I think it's really about what we're trying to achieve, and how can we still have competition and innovation with multiple players, different type of players, but without, with a safe and sound environment. So I think it's been very positive to see how regulators have been a lot more open to that discussion, thinking not only about, defining very strict rules that will just kind of limit our ability to provide a better, service to our customers, and limiting competition. But I think, nowadays, in most of the cases, in most of the places, we have seen regulators quite open to rules that are mainly focused on, the risk itself than just, defining rules.
Correct. And the question I always ask myself is, where does innovation happen, especially in the payment space? If the infrastructure itself is not, I guess, cooperative, and that everyone can access it in the same manner and use it the same manner, then you can't make the payment, and therefore innovation on top of that cannot happen. So I think the whole industry has to come together and really look at the foundation and make sure the foundation is sound and solid and it's accessible to everyone, and then we can innovate on top of that.
Yeah. If I can just add to what you both are saying, and totally endorse. In fact, my reading of the world, and I've had this discussion with several international payment operators, non-bank operators, is that you have today countries that have openly and clearly set the rules for doing cross-border payments and doing the last leg on the local instant scheme. Example, Australia as well, very clear process to validate going from an international payment to a local instant payment. So those examples are really important. Again, Australia comes up again. The US, of course, with the ACH plus ACH, I plus ACH. But at the end, the element that is common to that is these systems have to allow for the data to be carried to know exactly who are all the intervenients along the payment chain. And at the end, that's really what it boils down for those of you who are listening to this podcast. And this sounds maybe too theoretical, but at the end, the very basic requirement is everybody that participates into a payment, which has probably at least two parties and sometimes four or even more, everybody should knows who started it, who intervened in it, who is it going to lead to. And again, we have a world that is divided between countries that explicitly says, yes, you can, and this is how you do it. You have countries that says, clearly you cannot, don't try it. And at least that's clear. And then we have a lot of countries where it's not clearly defined yes or no, but there is common practice. And this is where the risk for our payments industry comes, because if at the end the jurisdiction may say, by the way, I didn't want you to do it, everybody gets fined, or please stop, you interrupt that innovation, you interrupt that service level that maybe has been reached at that point. It's a problem. On the other hand, if at the end a lot of parties did not do it, and at the end the rules are confirmed positive, well, there's a lot of set of parties that did not use this practice because they believe it was not allowed, and at the end it was allowed. So again, it's more about fairness of the system and the ability to enable everybody to do their job. And at the same time, on the example side, if you look at Europe with the SEPA and with the one leg out, in fact, you ended up having a highway that is clearly determined to do this one leg out payments, but then you have still highways from the past still being used that are not following the new highway. So if you are driving and you have a highway with some controls and a highway with no controls, as long as you don't have everybody going through the high-speed highway controls, you may take the one without controls. I mean, it's just common practice, but that's where jurisdictions, regulators have to realize that they have to be consistent, they have to be clear, they have to be prescriptive, and all of that will just allow to focus on the client services as opposed to the rules on how to work on payments on specific jurisdictions. I just want to add that.
Thank you, Bruno. That basically segues into my next set of questions, since you kind of already touched on the topic. How can regulators, though, ensure a level playing field between banks and fintechs while still encouraging innovation and protecting consumers? We've touched on the different regulators across various jurisdictions, but how can they collaborate better to level that playing field?
Yeah, no, that's a really good question, and I wish I had a golden bullet for that. And the idea of BAFT bringing this topic to the table, and that's, I think, what I have to recognize that this is a very important set of questions and observations to help regulators who may be able to get this paper, and that we are trying to get this paper to, is that there have to be some set of golden rules for payments. And where do these golden rules come from? Well, there are several bodies in the world that exist to create standards on how to make payments. From PMPG and CBR Plus and HLBS, they define, these are experts. I would not be able to do that, by the way, but they are real experts that define how the payments should be communicated, what fields are mandatory, which fields are important. Same with the BIS CPMI forum, which allows to define how payments should be as well done to reduce the risk in the financial system. There's FATF rules as well. And Wellsberg Group, for example, which looks more at compliance topics. But so there are worldwide forums and standard and best practices that do create content to define how it should be done in the best case. Now, they, apart from FATF, probably, they don't have teeth, meaning that at some point, what you need to do is to have a way to enforce it in the right way, independently of the jurisdiction. Because if I am issuing a payment in country A and I'm receiving in country B, and the way to interpret and to enforce this is different, but it's not going to be possible for one of them to do the job properly. So this is where central banks have to play and have been playing an important role as well to influence regulation on payments when it comes to RTGS, of course, but of course on the local jurisdictions. They have to play a role to be consistent on what they issue as regulators. They have to harmonize a bit what they're defining across regions, and they have to be prescriptive. That word, which is so important, is they do not have to leave room for interpretation. If you leave room for interpretation, this is where more regulation comes later on. We should stop creating more and more regulation. Last time I checked, I had like 245 different regulation sources having to do with all the payments that BNP Paribas has to do. So we cannot keep adding more regulation on regulation. It defeats the purpose. And number three, and I'll stop and I'll let my colleagues comment, is the good news is that technology is allowing us to do better things, and the common language. The arrival of ISO 2022 is allowing us to have a new opportunity to have the international payments messaging for the next maybe 40 years, I hope, where you have all the capacity to fulfill the data that is required for everybody to do their jobs, for international payments to speak to local instant payments because they share a similar format. Nevertheless, they still need rules, not because they are the same format, do they have the same rules as to how do you go from an international payment to a local instant payment. But the format is there and is being deployed, as you know, all across the world. Central banks are doing this, instant payment clearings are doing it, international payments are being changing right now on this between banks and later corporates and users. So language is there, technology is there, best practices bodies are there, regulation has to follow. And it is our duty as banks and as non-banks and industry participants to inform, to help the regulators understand the importance to be consistent and prescriptive on the golden rules for payments. That's a bit what I would share with you.
Yeah, I mean, to echo some of what Bruno has said, but the unfortunate truth too is every country's, I guess, payment operators, central banks have their own strategy and their own objectives as far as payments are concerned, especially on domestic perspective. And that's how they build the payment systems itself, right? And therefore, it's really up to the banks and the players in the space to educate the payment houses, the governments, and the central banks of what people or what banks and how the payment systems are actually used. You'd be surprised how many times we've gone to a regulator and say, "Did you realize this is happening?" And they actually did not realize something was happening. So I think there's a lot of education that needs to be done into the central banks and the payment systems itself too, to educate them, and then they can, then we can also advocate to what the rules should look like, especially from a prescriptive manner perspective.
But again, Ken, I would say that maybe I'm too optimistic, but I think that more recently, in the past few years, we have seen that regulators are a lot more connected, cross-border. So sharing lessons learned and seeking for, successful cases. So I think they are exchanging a lot of knowledge and lessons learned, and really aiming for a more standardized or international framework, as which is very different from what we have seen in the past. So I think that's quite positive in a sense that local nuances will remain and they are pretty much needed. But when it comes to cross-border payments, I think more and more we are seeing a trend that it's towards a more international standard for cross-border payments rules. I think ISO is ISO 222 is a great example. It's definitely focused on structure and format, but I think that will allow central banks and regulators to define more standardized international rules applicable for cross-border payments. Going beyond just the formatting itself. So I'm quite positive with respect to progress that we have made, and I think that in the near future, I see a very positive path in terms of getting to this harmonized framework internationally. Again, not creating more rules as you mentioned, but really having the same interpretation across the rules that most of the jurisdictions are defining. So I think in that sense, I see a positive path along the way.
I totally agree with you, Renata. And I mean, where we see it is because of experiments like IXB, RLN, where central banks are getting together, actually talking to one another now. Yes. And hopefully the trend continues.
But that needs to come with collaboration, right? So I think we cannot just rely on the regulators or just expect regulators to solve for this problem. I think, banks and NBFIs, tech providers included, I think we all have a very important role to play in this space, right? We cannot just wait and see, things to get better. I think that the level of discussion around, the existing problems today across multiple stakeholders is really critical for us to have this, to get to this harmonized stage in which interpretation of existing rules are quite similar without jeopardizing the ability for players to compete and innovate.
Great. Well, thank you all for those comments. One of the main components is obviously the regulatory bodies. They kind of hold the purse strings here, and we've established that we want activity-based regulations as well as collaboration among FIs and NBFIs. But what is the one message that you all would like to send to the regulatory bodies? Ken, you want to start us off?
Like what I said earlier on, it's be a little bit more prescriptive in some areas. Like, very simply, are you allowed to put cross-border payments through the local system or not? Just like how SEPA did it, where the specific defined originator account and Benny account must be in the same jurisdiction, and it takes away all interpretational rules. So, like you said, we need to, I guess, regulate by activity, and the activity needs to be well defined, and therefore there is no misinterpretation of the rule itself. I'll leave it at that.
Yeah, maybe I can just compliment and totally agree with you, Ken. I think it's really, my message would be, like adopting a risk-based and proportional regulatory approach that can ensure that regulations are fair to all players without jeopardizing innovation and competition, right? So it's going back to regulatory oversight being activity-based and not defined by the type of license of the entity itself.
And I'll just say that the safety of the system for payments is the responsibility of every single party, not just regulators, but as well banks and non-banks, innovators or not. And the question is, if we do not take care of this as a good, let's say, father of the activity or mother, at the end, it will end up with more regulation, which increases cost of the international payments and payments, increases burden. And so it's not necessarily a good idea to take advantage of everything that is not certain. I think it's important that we take care of the payment systems amongst all parties, looking at where things are clear, rules are clear, and where rules may need to be clarified, and speak to the regulators about it.
Thank you, Bruno. I want to thank the three of you for your comments here today. We do have a few questions from the audience, so we'll start in on that. The first question is, I am curious, what would be the risk, what would be the ask of regulators to specifically do to ensure even regulation among banks and NBFIs, PSBs, and MSBs? And we did cover that just now. The answer to that is collaboration, and also ensuring that the regulations are activity based and that the activity is specifically defined. So that's the answer to that question. I can move on to the next one. Can the unevenness in cross-border payments also be linked with costs associated with the payments for the end user? So for MSBs, the payments tend to be cheaper because they don't arguably need to follow all the more onerous rules, while banks tend to be more expensive because they have more rules to follow that add to the costs. Who wants to take that question?
Well, I'll go ahead. I'll try it, but clearly, more regulation adds more costs. More costs adds, I would see, even more problems on the efficiency of the payments to be delivered. The problem is that if to lower costs, you take the risk to go through a loophole of the regulation, you may end up having other problems like fines or reputational problems as well. So it's all for me a matter of weighing in the how to do things the most efficient way, and the only way to do that is to include all the information that you need in a payment, so that everybody in the chain can do their job the most automated, using robots, using artificial intelligence, of course. But for that, you need that data to be traveling, just as FATF rules say, all along the payment chain and not have any loss of data. If you start having less data, less information, you will end up stopping the payment, intervening, asking the question, asking for additional information. Of course, that adds costs. Not only adds costs, but it adds frustrations to everybody in the payment chain. So yes, it can improve costs.
Yeah, I think from a cost perspective, we have to be careful where the cost is. So are we saying that, MSBs and MBFIs are not doing sanctions filtering, all those? I would say they are, because no one will bank them unless they were doing the correct thing. The level of sanctions filtering is another thing which I cannot comment on. But the other component of cost, it's some of the unseen stuff, right? Why do MSBs want to put the payments through a low value system instead of wires? Because wires cost more. It just does. There are deductions along the way. There's uncertainty of how much the beneficiary actually gets. Whereas if you put it through an ACH or faster payment system, which generally is cheaper than an RTGS system, you get all those benefits of a surety of the payment itself as far as time and amount is concerned. So the question not is from, yes, there's a cost difference, but then if wires went down and we made everything even, then it should be the same, right? So cost is a factor, but more importantly, it is actually the service that's the factor. Why MSBs and MBFIs want a different rail other than the RTGSs, which so happens are cheaper.
Yeah, and I would say I think cost is a component, and it can have an implication to the final consumer and also the customer experience itself. I think this is also something that is pushing banks to improve their operational services and operational processes to reduce costs, improve customer experience. So I think this has been quite positive. Also, when it comes to operating at scale, usually you get cost efficiency as opposed to when you have smaller players. So I think cost now is definitely a focus for all players. And additional regulation does have an impact on cost. But again, as we focus on the interpretation of the regulation applied to the level, the type of activity of the providers, that shouldn't be driving costs, right? And with the new technologies, I think I'm quite optimistic towards how banks and non-bank FIs can be quite effective in reducing costs as they are improving customer experience at the same time.
Thank you. Our next question is, what can you say about the rules of cross-border payments made through banks that only provide online services? There are a considerable number of such accounts, not only individually, but also commercially. How can one be sure that these transactions comply with regulations? Do established and local banks apply special rules other than the general rules regarding this? Or is there a study on this?
I can try maybe just to give a first answer on this, because I think if the payment is a payment, so whatever media you're using to issue the payment, it has to, of course, go through the same transparency and data elements. However, if you're referring to online to be the fact that you are instantaneously issuing a payment and by that moment it has to comply, the good news is that we have the idea of pre-validation as a whole, and this is a principle that is possible thanks to the ISO XML, thanks to APIs, of course, thanks to the rules that are set, so that when you issue the payment, you ask the right questions. You're sending the payment to Singapore, this is required, do you have this code? Do you have this additional information on the address? And these questions should be asked upfront. The last thing that you want is that you do not complete the right information and you're asked later on, can you please provide it? We stopped your payment. We need to add you this additional information. So the answer is yes, online payment means have to include this pre-validation concept, which allows to know upfront that the payment will be successful. And that should be possible in the way that payments should work tomorrow. But the rules need to be clear, of course. That's the thing. Yeah.
Thank you, Bruno. I think we have our final question for today. A leading bank in Singapore is actually offering cross-border payments at zero cost. They hope you do the FX with them, but that is not a requirement. There's no deductions, at least for the US market, et cetera. Is this the way the industry will react to the MSBs?
I think there's a lot of banks that are doing that right now, and from an FX perspective, especially if you're actually putting things through the low value systems in a local country, that means there's always FX. There is never, very seldom. Let's just say that Singapore Bank is making a payment to the US. More than likely, they're restricted that, you have to debit a Singapore dollar account, and therefore you're forced to do FX with them 99% of the time. That 1% of the time that you don't do FX, it's a loss leader, right? And I have seen other banks do that around the world too, right? And that's where a lot of fintech actually says, I don't charge you anything, but then there is the FX cost and no one actually knows what the spread is. And that's where they make their money.
Got it. No, that makes, it makes total sense. Because if you have 9 out of 10 that will do the FX with you, you will make money on that then.
Yeah.
Even if that
I would say there's no free lunch, and but if you are providing a service with a very positive client experience with no direct fees, and in many cases consumers will look at that offering as a very positive and appealing offering, without thinking about the spreads. And in many cases, it's not only about the facts, but as you have a good experience, you're already a customer, you start using other services. So there is a cross-selling effect for providers that have multiple products to offer. So I think this is a very common strategy. I think there's nothing wrong with that. And to your point about, in overall, the net is usually positive, even if there are users that will only do that specific payment and paying no fees whatsoever. But I think it's part of, the nowadays strategy, and not only, we see banks and non-bank FIs, going after the same strategy. I think, again, it goes back to the customer experience and how you can make your final customer happy, in a sense that, he'll be willing to pay for other services and very happy with not paying for direct payment fees.
Thank you, Renata. Well, this has been a very informative webinar even for myself. So I want to give a special thanks to our panelists, as well as the BAFT team for making this webinar happen. Please let us know if you have any other further questions about this topic. And also, please be sure to fill out the survey immediately after the webinar. Your feedback helps us provide and improve upon content that is relevant to you and your organization. So thank you once again, and happy Thursday.